Hello, and welcome to the next installment of our Market Insights video series, in which we will be discussing the results for the third quarter of 2020, as well as what to expect for the remaining 3 months of 2020 and things to watch for as we go into 2021. You will hear conversations around the U.S. election, the COVID virus, vaccine progress, and other drivers of the economy and capital markets. We will follow a similar agenda to past videos. We will start by talking about the U.S. economy, since that is the natural backdrop to the capital markets we will discuss for the remainder of the video. We will progress to the traditional asset classes of fixed income, U.S. equities, and non-U.S. equities, and then move to the alternative asset classes: hedge funds, real estate, infrastructure, private equity, and private credit. We hope you will have some questions about the topics we discussed on this video. If you do have questions, we've provided each analyst's email address on the divider of each section, as well as a general contact email at the end of the presentation, so any questions that are on your mind can be addressed in a timely manner. Please don't be shy about asking questions. These videos are developed for your education and knowledge of the capital markets, so please ask a question about anything that's on your mind.
Hello, my name is Brandon Monfelt, and I cover the U.S. economy at Marquette Associates. The third quarter of 2020 proved to be nearly as eventful as the first two. In the presidential race, Biden is favored to win over Trump, as a second debate has been canceled due to Trump contracting COVID-19. Instead, there will be dueling town hall meetings. Though active coronavirus cases are still high, they are beginning to level off, and most states are widely reopening. Unemployment numbers are trending downwards, though initial claims are expected to remain elevated due to COVID-19 concerns. Schools on the whole have moved to a hybrid model of in-person and online classes in order to control the number of students in a class. Equity markets have also been moving upwards on a predicted large rebound in GDP for the third quarter. Atlanta Fed's GDP Now tool projects a 35.2% year-over-year increase. Active cases have moved upward, though at a slower rate amid states reopening. The death rate has plummeted as people begin to adjust to the new normal. A new vaccine is predicted to be available by April of next year. Even if a vaccine did get approved, nearly a quarter of people surveyed said they would not be interested in receiving a government-approved vaccine for COVID-19, with education level factoring into the decision heavily. The more education that someone has received, the more likely they are to want the vaccine. Schools are back in session, though not in the same in-person manner as before. Most colleges have adopted some sort of online learning into their curriculums, as only 3% of schools are having fully in-person learning this year. Concerned parents have questioned the usefulness of online and Zoom classes, as students can have video and sound off, not actually paying attention to the lesson being presented. A large majority of states are reopened or are in the process of reopening. Larger states such as California, Texas, Illinois, and New York are reversing their reopening plans as hotspots are popping up in certain counties. Though many states are reopening, they still have a large concentration of COVID-19 cases per capita. It remains to be seen whether increased cases of COVID-19 will keep occurring, and if they do, will we see more rollbacks of reopenings. In conjunction with some states brushing off COVID-19, it seems that voters share the same sentiment. Only 20% of participants listed coronavirus as their main concern for this next election, trailing the economy by a 12% margin. The economy seems to have rebounded sharply, though it remains to be seen if this will bolster a re-election bid for Trump. In the betting markets and in the polls, Biden is in the lead with a 65% chance of winning. This margin grew significantly after the first debate and has held steady since. The dueling town hall meeting should prove interesting and will undoubtedly shift the odds in one way or another, depending on the candidate's performance. Since Biden is favored for the election, many experts have begun thinking about the possibility of a blue wave, where Democrats control the House, the Senate, and the presidency. According to Goldman Sachs, the House is very likely to be Democrat, with the presidency and Senate more of a toss-up. Given these projections, there is a 38% total chance of a blue wave. This is an unlikely scenario, but is certainly possible.
Hi, I'm Ben Moore, Marquette's Director of Fixed Income. I'll be discussing our fixed income outlook. The third quarter was primarily characterized by the continued rebound and risk-on sentiment since March that drove strong returns in credit in anticipation of a potential COVID vaccine and the eventual end of the pandemic. However, that momentum lost steam towards the end of the quarter as a reminder that we are not out of the woods yet. In July and August, spreads tightened and the yield curve steepened, but that largely reversed in September as vaccine progress and the relief package stalled, while cases resurged in certain regions due in part to back to school and social distancing fatigue. The AG returned 0.6% in 3Q and 6.8% year to date. Bank loans gained 4.1% in 3Q but are negative 0.8% year to date. High yield was up 4.6% in 3Q and is back in the black with a 0.6% year to date. Finally, emerging markets debt rebounded 2.3% in 3Q but is still negative 0.5% year to date. The recovery remains hinged on potential vaccine approval, distribution, and adoption. Meanwhile, the U.S. presidential election, relief stimulus progress, and COVID cases resurging or receding will continue to drive short-term volatility. While spreads across fixed income asset classes have generally tightened in closer to the respective long-term averages, Treasury yields remain near all-time lows, only rising by an insignificant amount in 3Q as global investors kept one foot in haven treasuries while extending their other foot into credit and equities. The yield curve is still near historic lows and remains relatively flat despite rising and steepening from April through August. It fell and flattened in September, but the key risk is for rates to potentially rise and the curve to steepen dramatically in an eventual recovery from the pandemic, which would be a headwind to core bonds. Market implied inflation remains below realized inflation, showing investor pessimism. The expected trajectory for inflation remains low given the overabundance of oil, which factors into the costs of all goods, flexibility of oil producers to turn on rigs, and growth of the services and technology sectors that rely less on commodities. The Fed is committed to holding rates near zero through 2023. They are projecting moderate GDP, improving employment, and low inflation. An accommodative Fed should continue to provide a tailwind to credit. While it is impossible to predict the congressional debate on the status of the next stimulus package, we can still be assured of a long enough runway for future stimulus. U.S. government debt is higher than ever at 140% of GDP, but still lower than Japan's 200%. As another positive indicator, downgrades have abated from their March peak and returned to pre-COVID levels in 3Q. Fallen angels, bonds downgraded from investment grade to sub-investment grade, hit a record high in 1Q, but have declined meaningfully from 2Q to 3Q. The expectation is for both downgrades and fallen angels to remain low in the coming quarters, as those that have occurred for sectors marred by this pandemic, energy, retail, etc., are generally behind us. Current spreads for bank loan and EMD have proven to be historically profitable when allocating at these valuations, but that is no longer the case for investment grade and high-yield bonds. Bank loan spreads still show value, but high-yield spreads are now at long-term averages and signal less compelling value. EMD spreads remain wide and are still showing value. However, given poorer healthcare infrastructures, smaller EM economies may struggle with the pandemic longer. Bank loan and CLO issuance sprang back to life in September as demand is gradually returning. Investors wary of low and declining yields kept supply in check. The low supply in the face of growing demand may be a tailwind in go-forward quarters. Meanwhile, bank loan and high-yield maturity walls are still pushed out, a tailwind for credit. In terms of key credit indicators, new issuance, use of proceeds, and aggressive issuance are still benign. Use of proceeds towards acquisitions and LBOs for both high-yield and bank loans have declined, And we can see here that triple C and second lien issuance is now very low. But leverage, coverage, issuance, and outstanding, not shown here, are at concerning levels. Both bank loan and high yield default rates have reached the approximately 5% mark as expected, and the expectation is another 5 to 10% in defaults, to reach a roughly 10 to 15% default rate total attributed to this pandemic. However, the key dynamic to keep in mind here is that historically spreads tighten well before defaults peak, as they did in 2008, and as they have during this crisis. Market distress levels reached close to 2008 housing crisis levels at the end of March, but have declined to below 2015 show crisis levels. However, distress levels are still quite high. Depending on vaccine progress, we may see distress levels resurge. In summary, we continue to recommend maintaining strategic allocations in fixed income portfolios. Diversification will be especially important in the coming quarter to provide principal protection if the market pulls back due to potential COVID second or third waves, further delays to the vaccine, and election volatility. Diversification is also important for capturing the upside upon approval and distribution of the vaccine. The expectation is for fixed income allocations to continue to provide yield, diversification, principal protection, and liquidity for overall portfolios. For core bonds, the yield curve remains near historic lows and flats. Downgrade and fallen angel activity is back to normal levels, and the Fed is committed to stimulus. For bank loans and high yield, valuations, fundamentals, and technicals are no longer as attractive as they were at the end of 2Q, but moderate with some areas of concern. Lastly, EMD still shows value, but EM economies may struggle with the pandemic longer.
Hi, my name is Colleen Flannery, and I will be reviewing U.S. equities. In the third quarter, equity markets continued the recovery rally that began on March 23rd. Largely, we saw risk-on themes continue, as the S&P 500 rose another 8.9% despite a notable 3.8% decline in September. Overall, growth leadership continued across the market cap spectrum until August. The Russell 1000 growth outperformed the Russell 1000 value by 10.8% through the end of the first 2 months, but trailed its value counterpart by 2.2% in September. While growthier sectors like consumer discretionary rebounded on the reopening of retail stores, and tech dominated through our increased reliance on software in a COVID-19 environment, we did see positive returns in more challenged sectors like industrials and materials. Relative to large cap, the small and mid cap indices did not see value leadership in September. It would seem that investors are still wary of some of the more cyclical or economically sensitive sectors like financials or energy further down the cap spectrum. So, if sentiment was largely positive since the market bottom in March, what happened in September? The pullback was largely driven by the same stocks that led the market rise in 2020. FANG. Collectively, Facebook, Amazon, Apple, Microsoft, and Google fell 9.1% during the month, compared to all other index constituents, of which fell only 2.1%. The pullback in these brand name mega cap stocks comes at a time when investors seem to challenge their valuations. It would appear this slight correction accomplished what it set out to do. The median price to earnings ratio, a common gauge for a stock's affordability, for FANG compressed 13.4% in September. Still, on this chart, we see the top 5 names of the S&P have returned an astounding 42% year-to-date, while the rest of the index is still in negative territory. These 5 behemoths aren't the only areas of the market that are showing unusual strength year-to-date. This chart shows the historical 10-year range of annual price return for various indices as well as sectors of the S&P 500. If we look at the green square on the chart, the NASDAQ has returned more than 10% over its 25-year average, all while the U.S. is still in the throes of an unprecedented economic shutdown. The technology and consumer discretionary sectors have also generated above-average returns, while traditional value-oriented sectors like energy and financials are returning well below anything we have seen in the last 10 years. Although the strong returns from companies on the cutting edge of innovation seem warranted in a consumer-driven environment that must leverage apps, computers, cameras, and phones to stay connected, it seems hard to believe that the consumer discretionary sector, 42% of which is made up of restaurants, hotels, and retail companies, would be trading so high. To drive home the narrative of narrow market leadership, here we show how stocks perform according to their price-to-earnings ratio. Year-to-date, expensive stocks have outperformed cheap stocks, or in other words, growth stocks have outperformed value stocks, as they have for the last 4 years. As mentioned in our last quarterly update, we would have anticipated a change in leadership, as we've seen in past bear markets. For example, we've experienced strong growth leadership following the global financial crisis, which was predated by value dominance post-dot-com bubble. While the September balancing of style leadership was warmly welcomed by many, it follows the many fits and starts we have seen from value this year. Large and mid-cap valuations continue to be above historical averages. The S&P 500 is trading in the top 10% of its history. Mid-caps are trading at about a 10% discount to large caps, and small caps are trading at about a 43% discount to their large cap peers. We see a market that continues to be disconnected from earnings and in some places Main Street. In this chart, we see second quarter earnings for the S&P drop more than 31%. This was the largest year-over-year decline in reported earnings since the fourth quarter of 2009. To add perspective, the first quarter of 2009 earnings decline came in just over 41%. And it took the index 102 days to recover from the initial market drawdown of the global financial crisis. In 2020, that stock market recovery only took 45 days. Going forward, analysts predict continued earnings losses, though improving in both third and fourth quarters. That said, many analysts are expecting positive earnings growth to resume in first quarter 2021. With that backdrop in mind, we expect heightened volatility for the remainder of the year. Not only is the U.S. continuing to fight rising infection rates, but we are weeks away from what's been an eventful election season, with both presidential and congressional leadership potentially in flux. That said, volatility does not necessarily mean negative returns. On this slide, we show the last 8 presidential election cycles. Typically, the markets are generally positive pre- and post-election. The notable declines include the global financial crisis and the early 2000s dot-com bubble bust. Absent a major recession, we typically expect markets to finish the year positively. Given the record-breaking rebound this year, that outcome is becoming more and more likely. The big question, however, still remains. How much longer will the U.S. equity market sustain this rally? We saw a slight pullback in growth stocks in September, but since, market leadership remains narrow and seems unlikely to widen until a viable vaccine is found and adopted. Neither of these milestones seem likely before the November 3rd election, which will only add uncertainty and volatility to the markets. As earnings and expectations continue to be negative in the near term, there is light at the end of the tunnel with positive growth in the new year. We expect valuations to continue to rise due to lower earnings. However, there is potential for multiple contraction given lofty valuations. Eventually, investors will demand stronger economic fundamentals and corporate earnings in the present to sustain these levels. We will be monitoring these ongoing risks and their impact on economic activity and sentiment going forward.
I'm David Hernandez, and I will be covering the non-U.S. equities section. After 5 straight positive months, equities pulled back in September, though still had a strong third quarter. The MSCI Equity Index, the global equity benchmark, returned 8.1%. In 3Q, emerging markets significantly outperformed developed markets, 9.6% versus 4.8%.
Small caps for both emerging markets and developed markets outperformed their larger cap counterparts. In the upcoming charts, we'll discuss why we think EM has performed so well compared to DM, as well as look at where valuations are given the strong returns we've seen over the last 5 months. But first, let's take a minute to reflect on how good this rally has been. Global equities found their recent bottom near the end of the first quarter. Since then, both U.S. and non-U.S. equities have rallied. From the March 23rd lows, the S&P 500 has returned 52%. The MSCI EAFE returned 39%, and the MSCI EM index gained 45%. So it's been quite a sharp and strong rebound after a dramatic sell-off in the first quarter. However, not all stocks have performed the same. In fact, there has been some very dramatic differences. Year-to-date, growth and momentum, those factors have been the strongest performing factors, while value and yield have been the poorest performing factors. The low volatility and quality factors have also been negative year-to-date. Looking at sector performance, IT, information technology, has been the standout, returning 16.8% year-to-date compared to the broad ACWI ex-US benchmark, which has lost 5.4% year-to-date. This is a 2,200 basis point difference. Now let's put some historical context on the strong performance from growth, which has been helped by the strong performance from the IT sector. Here we have the rolling one-year return difference between the MSCI EM Growth Index and the MSCI EM Value Index. When the line is above zero, growth is outperforming. When the line is below zero, value is outperforming. Over the last 12 months, growth has outperformed value by an absolute 32.5%. This is the largest it has been over the last 20 years. Now, there's a similar story when we're looking at the data for the MSCI EAFE index, but it's even more dramatic in emerging markets. And a key reason for that is sector exposure. The MSCI EM index has a 19% weight to information technology. In comparison, the MSCI EAFE index only has 9%, so half that. In the United States, the S&P 500 has 28%, so even more than emerging markets. And this provides a key explanation why the S&P 500 has done so well. It has lower exposure to cyclical sectors that have struggled, particularly in this COVID environment, and it has higher exposure to tech, which has flourished in this COVID environment with the work-at-home policies really throughout the globe. Now, breaking down that 19% EM exposure, we see that the majority of that is coming from EM Asia, which has 23% in IT. In comparison, Latin America and EMEA, which stands for Europe, Middle East, and Africa, have only 2% and 0% respectively. So 2 points I would make. First, EM investing opportunities can be very different across regions, as this chart shows. And second, the larger exposure to IT has led to emerging markets outperforming non-U.S. developed markets. And should information technology continue to perform well, that should benefit emerging markets, particularly those in Asia, China, Taiwan, and Korea. As a result of the strong performance from emerging markets in the S&P 500, the valuation metrics for these two indices are on average a bit higher than the MSCI EAFE and MSCI EAFE small cap benchmarks. But all four asset classes are trading at high earnings multiples. And you can see that here at the top of the table, the top two lines. Now, this is due in large part to the low interest rate environment, which became even lower in 2020 as a result of COVID, as central banks throughout the world cut interest rates along with implemented several other monetary stimulus measures. Now, while the low rates are supportive of high multiples, we do think this gives equities less wiggle room to navigate any negative surprises that may occur into the future. And as we enter 2021, we think that there are several events and several topics that investors should watch for the possibility of negative surprises. 2021 earnings are certainly on that list. It's no surprise that we've seen negative earnings growth for these broad benchmarks here in 2020. However, looking forward to next year, expectations are high, and they range from 25% to 40%. Granted, this is coming off a negative year in 2020, but an unexpected surge in COVID cases could make these numbers tougher to hit. And speaking about COVID cases, if we look at Europe has seen a recent uptick in new COVID cases, while China and most of Asia largely continue to keep the virus in check. Additionally, markets have been increasingly optimistic on positive vaccine news, and we hope that that does come to fruition. Now, we've talked about how growth stocks have benefited from the COVID environment as consumers have shifted online. Many internet businesses have performed extremely well in this stay-at-home environment. So an interesting question, given the historical performance that growth has had over value, an interesting question is, will a vaccine lead to a rally in value stocks? I think you can make a strong case for that snapback in value if a vaccine comes about and is implemented in large throughout the globe. And this is going to be something that we'll be watching for here in 2021. Let's wrap things up for non-U.S. equities. After 5 straight months of positive returns, equity markets pulled back in September, but they still ended with a very strong third quarter. Asia has continued to keep COVID in control, while Europe has seen a recent uptick in new cases over the last couple of months. Growth stocks have undoubtedly benefited from the COVID environment and the work-at-home environment, particularly within the IT sector. But a good question is, will a vaccine lead to a value rally? Earnings expectations for 2021 are high, coming off a low and a negative 2020. If we look over the next coming quarters, there's 3 key events that we'll be watching that can influence equity returns. U.S. elections, Brexit negotiations. Yes, I know many of us have forgotten about that, but that's still on the table for this quarter. And the last but not least, and hopefully we will continue to see progress on a vaccine for COVID-19.
My name is Jessica Noviscus, and I will be reviewing hedge funds. Hedge funds posted solid gains in the third quarter and are now positive on the year. The group participated in the market rally in July and August and held up better than the S&P 500 in the September correction. Equity hedge strategies were some of the strongest performing in the quarter. Within the group, technology and healthcare funds continue to stand out, up 18% and 10% respectively year to date. Event-driven strategies also performed well in the third quarter, with gains across a range of sub-strategies including arbitrage, activist, and distressed. Volatility risk premium, as measured by the CBOE put-right index, also had a strong quarter, up 7.2%, capturing 80% of the S&P 500's quarterly return. This chart tracks cumulative performance of the hedge fund universe, as measured by the daily HFRX Global Hedge Fund Index relative to the S&P 500. Hedge funds did a good job protecting capital earlier this year as the market sold off late February into March and again in September, when the market was down almost 10% at one point. As you would expect, hedge funds did trail as the market popped off March lows and are behind the S&P year to date, but look at the difference in volatility. Over a full cycle, that should lead to more favorable risk-adjusted returns. This chart shows how gross and net leverage of U.S. equity long-short funds has changed over the last 9 months. Gross leverage has largely tracked with the market. It peaked at 200% in late January and bottomed near 160% with the market in late March. Gross had gotten as high as 193% in late July and hung around that level before coming down some with the market in September. Net exposure started the year around 50%, bottomed in the mid-30s, and is now at year-to-date highs at 56%. Both gross and net levels suggest hedge fund managers are feeling more bullish about the market and their opportunities from here. This slide compares performance of the top 50 most crowded hedge fund longs to the top 50 most crowded hedge fund shorts. You can see the two have performed fairly similarly this year, which makes sense given the impact of more macro and external factors on the market. As of the end of September, the longs were modestly outpacing the shorts year to date, which is a tailwind for hedge funds in these names. and from here, the environment for long-short stock picking should continue to improve, as true winners and losers post-COVID emerge. This chart is relevant for volatility risk premium strategies. It tracks the VIX index and at-the-money S&P put option premiums year to date. While the VIX and premiums have corrected since the spike in March, premiums are still well above average, which improves the return profile of VRP strategies collecting these premiums. To the extent that expected volatility remains higher, which seems likely given the presidential election and all of the unknowns surrounding a vaccine, VRP strategies will continue to be well positioned. This chart shows the percentage of loans in CLOs trading below $80, a key threshold for stressed loans. This metric has continued to correct post the spike in March and now sits just under 6%. While a big improvement, this is still higher than the 1 to 2% it was trending pre-crisis, creating a more attractive opportunity set for stressed and distressed credit investors. And lastly, final thoughts. Hedge funds have generally performed as expected this year, protecting capital on the downside and reducing volatility. This was most evident in the initial market sell-off earlier this year and then again in September. While hedge funds as a group are up modestly year to date, trailing the S&P by about 5%, the top quartile of U.S. hedge funds is up almost 10%, outperforming the S&P by 4%. We use the HFRI benchmarks to look at the asset class as a whole, but it's important to recognize that an investor is not investing in the asset class, and that through manager due diligence and selection, you can add these top performing funds to a portfolio and improve diversification, volatility, and return. And as we look forward, hedge funds are especially well positioned to navigate this environment with the heightened uncertainty and volatility. Hedge funds generally run with less beta, so are less exposed to big swings in the market and can generate more alpha through both long and short positions, regardless of what the underlying market is doing. And VRP strategies as a subset of our hedge fund universe are also well positioned, with option premiums holding at above average levels amid the heightened uncertainty in the market.
My name is Will Dupree, Senior Real Assets Analyst at Marquette, and I will review the current real estate market environment. For the second quarter of 2020, the MPI generated a total return of negative 1%. Of this, 1% was attributable to income, while negative 2% was attributable to appreciation. On a rolling one-year basis, the MPI generated a total return of 2.7%. Of this, 4.4% was driven by income, while negative 1.7% was driven by appreciation. For the second quarter of 2020, the Odyssey generated a total return of negative 1.6%. And of this, 0.9% was driven by income, while negative 2.5% was driven by appreciation. On a one-year rolling basis, the Odyssey generated a total return of 2.2%. Of this, 4.1% was driven by income, while negative 1.9% was driven by appreciation. Going forward, we would anticipate continuation of moderate returns in the mid to single-digit range for core real estate. Regarding real estate fundamentals, the cap rate spread to 10-year U.S. Treasury yields remains healthy and near historical averages. New commercial real estate supply remains largely in check, as evidenced by low vacancy rates, positive leasing trends, and positive rent growth. Regarding property trends, managers anticipate adjusting their portfolios throughout the year, with the clearest trends being net selling of office and retail, net buying of multifamily, industrial, and medical office, selective purchases within storage and senior housing, and net neutrality on hotels and student housing. We've also noticed more discussion within the niche property types of freezer cooler self-storage, lab life sciences, data centers, and truck terminals. Private managers are starting to research and lightly venture into these sectors. Looking at U.S. REIT performance from February 21st, the beginning of the COVID-19 sell-off, to the end of Q3, data centers, self-storage, and industrial properties have been the top performing sectors, followed by life sciences and single-family homes. Relative to peers, most of the properties in these industries displayed a general immunity to the COVID-19 driven recession. These industries have also been growing at a faster rate than the rate of U.S. GDP, and in many respects benefited from the outbreak. Alternatively, regional malls, lodging, shopping centers, and office continue to be the worst performing sectors, each down nearly 40% or more for the period. This comes as no surprise to investors, as these properties had been experiencing significant headwinds prior to the pandemic. While the pain of the pandemic was a significant detractor, it merely pushed things further in the direction they were already moving towards. Addressing both near and long-term impacts on real estate. As noted earlier, lodging, retail, and senior housing face the greatest challenges. On the backdrop of economic shutdown, lodging and retail have experienced immediate drop-offs in revenue, resulting in severe NOI declines. Additionally, rent and interest payments have been and will be deferred as tenants focus on liquidity and strengthening their balance sheets. Senior housing tenancy has been severely impacted by COVID due to dramatically higher mortality rates amongst the elderly, creating serious challenges for senior housing operators in the near term. Facilities are often staffed with skilled nursing professionals, which are in high demand and short supply. Furthermore, operating costs continue to rise across states due to newly implemented safety protocols and regulations. Office and industrial properties have not been immune to the impacts of COVID, but their challenges have not been as severe. Industrial has experienced some supply chain disruptions following trade wars and some decreased global demand, but these challenges are becoming longer-term tailwinds as companies look to nearshore their supply chains and increase inventories. Furthermore, stay-at-home mandates have only accelerated the growth of e-commerce and thus the demand for warehouse tenancy. Despite the short-term challenge of suppressed new leasing activity, office has remained afloat as rent collections appear healthy. However, the long-term success of the sector will be entirely dependent upon the future of working from home, which will be very much determined on a firm-by-firm basis. Some companies may shift to permanent work-from-home models and entirely reduce their office footprints, while others will keep their current office spaces and adopt shorter in-office work weeks instead. Ultimately, an eventual office exodus trend appears more and more inevitable. However, various factors could offset or minimize this, such as the permanent need for social distancing and new square footage per employee. Multifamily has been an insulated asset class as the trend of renting versus home ownership gains momentum due to an increasing unemployment rate. Rental growth is expected to grow, especially in areas with young working populations and strong economic tailwinds. Rent collection remains intact, however, absent further stimulus, certain households could struggle once unemployment benefits expire. Looking closer at the composition of the Odyssey Index, the sectors most impacted by COVID, retail, hotels, senior housing, and student housing, represent a smaller portion of the index compared to office, apartment, and industrial. On a quarterly basis, the index sleeves of these sectors continue to marginally decrease, while the sleeves of the industrial and apartment sectors continue to marginally increase. Growth and thus demand of the office sector remains stagnant as employers continue pondering the potential of moving to a remote workforce. Additionally, the underlying properties in the index are predominantly on the East and West Coast, which collectively account for over 70% of the index. While the South represents nearly 20% of the index, this region continues to see upward trends in both population growth and white-collar job growth. Analyzing cap rates and valuations, the current spread to the U.S. 10-year Treasury over 300 basis points has only been seen 5 times since 1995. Reviewing the returns over the next 3 and 5 year periods, returns averaged 10.8% and 11.3% respectively. Digging deeper on previous downturns, real estate fundamentals were strong prior to the COVID-19 pandemic. As supply was manageable, properties and funds were using low amounts of leverage, and the market was supported by both strong credit fundamentals and low interest rates. Furthermore, analyzing peak-to-trough performance, the S&P 500 and the North American All-Equity REIT Index did not experience as deep a drawdown compared to previous market downturns. These factors should support a quicker and more accommodative recovery. Longer term, we expect the recovery to take hold, but the impact to private real estate over the next few quarters rests largely on 1. How quickly economic activity resumes, particularly if we experience a second wave and another lockdown, and 2. The extent to which tenants default on future rent payments. Of particular concern are the sectors with substantial exposure to travel and retail, since people would be confined to their homes due to shelter-in-place orders. Due to the lagged nature of real estate returns, the impacts will trail the equity and bond markets similarly to previous downturns, such as the 2008 financial crisis. Although short-term performance challenges loom, the long-term thesis for private real estate remains, and it should continue to be an accretive component to portfolios in terms of both diversification and returns.
I'm Joe McGuane, and I'll be covering the infrastructure section today. Unlisted infrastructure in Q3 has continued the trend of capital consolidation in the wider private capital space. Against Q2, capital raised is up 56%, but achieved by only 60% the number of funds. As COVID-19's impact became clear, one increasingly source of value across the industry includes established relationships, which experienced fund managers with higher fundraising targets are leveraging to pull away from smaller funds. Looking at the amount of time spent in market, a small portion of funds closed in Q3 spent more than 3 years raising. Among them, Oaktree Transportation Infrastructure Fund made up just under 7% of the aggregate capital raised in Q3. This is in line with results so far in 2020, which suggests funds are taking longer to close on average. After a clear slowdown in deal activity over Q2, data from Q3 shows an encouraging increase in the number of deals done, alongside a similar increase in aggregate deal value. While activity in Q3 is still way below any quarter for the past 5 years, another jump like that from Q2 going into Q4 would see the market return to typical pre-pandemic levels. Average deal size is holding at $175 million in Q3, above the long-term average of $151 million. North America has regained some of its lost ground from the previous quarter. From Q1 to Q2, the number of deals in the region dropped by 49%, bouncing back 62% into Q3. Across Europe, however, the emergence of secondary waves of infection and lockdown-light regimes will be forcing buyers to reassess the value of infrastructure opportunities, as well as the credibility of delivering major capital programs. Looking at deal flow by sector, it is clear that transport is bearing the brunt of COVID-19 headwinds. Average quarterly deal count in this sector is down 45% in 2020 compared with 2019. On the other hand, renewable energy deals have fared relatively well, dropping just 13%. With conventional energy deals down to 44%, it seems ESG commitments are providing a sector hedge in downturns. As the world contemplates the prospect of reaching post-peak oil driven by negative medium-term economic outlooks, renewable energy is, and has for some time, been a key driver of infrastructure investment. And finally, infrastructure is expected to be less sensitive to broader market and economic movements. A second wave of COVID-19 across various regions could force governments to reimpose restrictions and delaying infrastructure investment programs. Renewable energy deal activity returned to pre-pandemic levels during the third quarter. Transaction activity has slowly increased, particularly from corporate entities seeking additional balance sheet flexibility.
Turning to private equity. My name is Derek Schmidt, Marquette's Director of Private Equity, and I'll be reviewing the current market environment. While we continue to await 2Q numbers for the industry, preliminary numbers within the buyout space appear to have fully rebounded in 2020, with the venture capital performance remaining significantly positive ahead of a strongly anticipated second half IPO market. The largest managers have already reported 2Q earnings, and while you can see a recovery is already underway within private businesses in the second quarter, these managers also heavily utilize a public market comparable basis to value their businesses, as opposed to DCF and private market transactions, which are primarily utilized for smaller company valuations. As a reminder, these downturns in the market have been very attractive and rewarding vintages for private equity investors. And we see this as a similar opportunity and would encourage investors to maintain or do a little more in terms of their commitments to private equity in 2020 and 2021. In fact, the growing disconnect between public and private market valuations remains large, reflecting a 46% discount in private market transactions in August relative to the Russell 3000. We continue to believe the most attractive area of the private market is within small funds focused on taking advantage of the persistent inefficiency of small companies. And here you can see the discount is closer to 60%, which remains very attractive. The private equity industry remains as well capitalized as it has ever been and well prepared for this market correction. Record fundraising during recent years has positioned most private equity firms with the dry powder needed to not only support their portfolio companies, but to partner with businesses either experiencing strong growth due to this correction or businesses that are more anxious to sell to an experienced partner. However, similar to the previous two market corrections, we have seen a slowdown in deal volume in the first half of the year. This slowdown has been a bit more aggressive as there have been travel restrictions in place across the country. But the second half deal volume has picked up as travel has resumed and capital is being put to work as those virtual conversations that took place early in the year are now resulting in realized transactions with face-to-face meetings resuming. Capital calls and distributions have slowed significantly in the past downturns. This downturn has been a bit different in that many private equity firms are utilizing capital call facilities, which they quickly drew down in 2Q. This caused an increase in capital calls from LPs, but without investment activity. We would expect going forward lower than expected capital calls and distributions during the second half of the year. But again, this is uncertain based upon the response to reducing the COVID crisis. One trend we have more confidence in predicting is that private equity companies are likely to continue to extend the holding times of their businesses. These hold times have been slowly increasing, and this crisis is almost certainly to extend those due to the operational stress, the new capital these private equity firms have infused into their businesses, and the continued uncertainty being priced into transactions. This long-term focus on business value supports the benefit that private equity has in its active role in investing capital and maximizing returns for investors. One area of the private markets that we would like to call out that has remained active and continues to provide strong market growth opportunities is the growth equity space. Growth equity managers continue to see these opportunities as companies grow bigger and they remain private for longer. We see growth equity transactions accelerating in the second half and into the fourth quarter as a growing number of funds that have been raised in this area of the market deploy capital. And finally, takeaways from the quarter. The private equity opportunity is compelling. Now is the time to either start, increase, or accelerate private equity programs for institutional investors who can take advantage of their ability to invest in illiquid asset classes. Vintages following these downturns have provided very attractive returns for investors, and we expect 2020 and 2021 to be similarly attractive. Elevated public market valuations make the relative value of private equity even more attractive today, with businesses transacting in the private markets at nearly 10 times relative to that of the public market, with the Russell 3000 trading at 18.4 times. Fundraising efforts that slowed during the first half of the year with travel restrictions have now re-accelerated, and we would expect a very strong fourth quarter push as managers look to close their funds. And finally, while the economic downturn is certainly unique, and it's still too early to tell exactly how this one will play out, private equity has performed very well to date, as managers have worked closely with their portfolio companies and have the capital needed to support their businesses and make new investments.
Turning briefly to private credit, my name is Brett Graffey, Alternatives Analyst at Marquette Associates. Since the Great Financial Crisis, private credit underwriting standards have weakened significantly. Today, adjustments and add-backs account for approximately 25% of overall EBITDA. Additionally, total debt to EBITDA multiples on middle market deals have reached an all-time high of 6.5 times. The resetting of valuations and the deleveraging of balance sheets as a likely outcome of the COVID-19 pandemic will lead to attractive opportunities for private credit managers going forward. In the midst of the great financial crisis, total loan volumes dropped off meaningfully. As a result of the crisis and increased bank regulations, banks began to dial back their lending practices and impose higher standards on prospective borrowers. As businesses began to return to normal, private credit managers filled the void left by the banks and have gained substantial market share as a result. Additionally, during the great financial crisis, pricing increased considerably. Post-crisis until now, yields have fallen slightly as LIBOR levels and interest rates have decreased, but private credit yields remain higher than high-yield bonds and syndicated leveraged loans. While we have not seen a spike in yields, primarily due to the lack of new deals, anecdotally, managers are seeing 200 to 300 basis point increases in yield compared to pre-COVID levels. Digging deeper on issuance, the first and second quarters of 2020 had the lowest new loan volume since 2008. The third quarter was much of the same, with depressed loan volumes being lower than Q3 2009 totals. While activity has been muted, it is the hope of investors that we are nearing the end and activity will start to pick up as we move beyond election season into late 2020 and early 2021. Since the second quarter of 2009, on a rolling one-year basis, private credit has only posted one quarter of negative returns, as well as posting 9 straight quarters of double-digit returns from the second quarter 2009 to the first quarter 2012, highlighting the strength of the asset class post-crisis and the consistent returns provided to investors during that time. Private credit yields continue to have greater than 250 basis points of premium over high-yield bonds and broadly syndicated loans. Strong yields and low correlation should continue to benefit middle market loans, providing positive differentiation from other fixed income asset classes. Looking at multiple cycles of data, going back to 1992, private credit is the best performing asset class in a downturn. We continue to believe that private credit allocations will provide investors a defensive allocation shift as the asset class has demonstrated strong downside performance and diversification benefits against other private and public asset classes. As expected, due to the COVID pandemic, fundraising through the first 3 quarters has been slow in private credit, totaling slightly over $50 billion, approximately half of what it was raised through the first 3 quarters in 2019. That trend is expected to persist through 2020, but the industry remains well capitalized with over $250 billion in dry powder. While opportunities to finance new M&A are likely to be limited, the current market is a target-rich environment for private credit as new opportunities arise from broken deals in the syndicated market and companies looking to refinance their existing debt. Private credit managers are indicating that they're still open for business in this market, but the criteria to get a deal done is higher as it will take more lender-friendly terms, higher pricing, and more collateral support. We believe that managers who have strong sourcing networks, deep experienced teams, and have exhibited discipline in their underwriting are well positioned coming out of this difficult market environment.
We'd like to thank you for watching this video today. We hope it has been of use for you and your committee members as you try to understand what has happened for the last 3 months of 2020, as well as to what to watch for the remainder of the year. If you have any questions about the content that was discussed on this video today, there are a number of ways in which you can have your questions answered. If you're one of our clients, you can reach out to your consultant for more information. The consultant can either address the question or put you in touch with the appropriate research analyst. You can also send us an email. If you have specific inquiries, please use the first email address listed in red here under the 3rd arrow. Or if you have general inquiries, you can use the 4th email if you would like to ask about anything related to Marquette. In terms of next steps, if you have any feedback about these videos, please share them with us. We want these to be optimal for you and your committees to get the most out of them. So if there is something we can be doing differently, please share those ideas with us. Please subscribe to our channel for the quarterly Markets Insights videos. In mid-January, we'll be posting a video about 2021 preview and what to expect out of the markets during 2021. You can register for our research email alerts on our website, so any research we develop is sent automatically to your inbox, and you don't have to go and visit our website to download the latest piece we have released. We'd like to thank you for spending some time with us and watching this video, and we'll see you next time.